Yeah, so I'm excited about it because, what we've had up till now is these trade-weighted indexes, and they're very national focused. So like the US has a trade-weighted index, and what people trade commonly is called the dollar index. And in the dollar index is several currencies. But two of the US major trading partners aren't even in there, Mexico and China. And Europe is given this extra weighting. And so two things. One is I wanted to correct that. And secondly, I think that in this time that I sort of see as a time of rising economic nationalism, not just in the United States, not just in China, Europe, other parts of Asia, India. And so I kind of think that for people who, like myself, are really committed to internationalization, to globalism, that we have to have new tools to look at things. And a GDP-weighted currency basket is sort of an interesting approach to there. And unlike other baskets, like the dollar index doesn't really have the dollar in it. The GDP-weighted will, and it's dynamic, so that, for example, last year, India moved into 5th place in the world's largest economies. And so in my basket, I have a little bit more of a place for India. And as China already number 2 in the world economy, looking at nominal GDP, so the 3 big blocks, the US, China, and the Eurozone, the 3 of them make up about, GDP-wise, it makes about 65% of the world's economy. So 2/3 of my basket. That's looking at just the currency, but also the other innovation. It's sort of kind of funny, like, right, that since these other products exist, as an entrepreneur, as a business person, I got to say my mousetrap, I've got a better mousetrap or a newer mousetrap. And one of the things, excuse me, that I do in this index is rather than just take spot prices, I really have a basket of 1 month forwards. And so using the forward rates, it also generates a GDP-weighted interest rate for the world. And I think that also can be like a benchmark. And so I do think, though, you're right, that, and the reason I picked GDP was that a lot of other good things are correlated with GDP. No, the index itself is just really trying to be like what we call the KISS method. Keep it simple, stupid. And so the idea is have only one variable at a time, but I think you're right that these political issues, for example, in March and early April, when the pandemic was first breaking out, the dollar strengthened. And so that would have, of course, because the dollar plays a role in a GDP-weighted basket, it affects what happens. So that and that's why I think that focusing on the currencies, it's the biggest of the capital markets, $6.6 trillion a day. So that means that by the end of business tomorrow, this week, we would have seen enough foreign exchange turnover to cover the whole year's worth of global trade. So the foreign exchange market, I want to say it's the biggest and deepest of the capital markets. And so, but you're right, it only gives us, that story they tell, maybe in Chinese schools, I know they tell them in Indian schools, about 5 blind men, and they're walking in the jungle, and they stumble on an elephant, but they don't know it's an elephant because they're blind. So one person feels the legs and says it's a tree. Another person feels the ears and thinks it's a leaf. Another one feels the side and says it's a wall. And so I do think we have to be careful about taking our view of the elephant that we're feeling and extrapolating it. And that's why I think that it's only one dimension. A currency basket, of course, is only one dimension, but because GDP, it is a big market, currencies, and GDP is highly correlated to other things, other developmental measures. And what it really gets to, and really what it highlights, I think, about India and China, is that although these countries are very big economies, right, they're among the biggest in the world, that they're still really relatively poor countries. Large, high GDP, for sure. Powerful countries, but still much poorer than many countries in Western Europe and the United States. So I think that challenge, which doesn't get measured in GDP, we got to look at GDP per capita. That's the next basket. So what we do is we got this we hired them to do the hard work, and the hard work is the calculations and maintaining it. And so how do we know how big an economy is? we could take U.S. economic data and the Eurozone's economic data, but instead we're going to go with the World Bank's. So it's an official that comes out once a year. And so Bloomberg is going to just, partly because people use Bloomberg a lot in the industry, and so they're going to be, so on Bloomberg now you can find both indexes, both the currency, the GDP weighted currency, and the interest rate component. When you think about a forward exchange rate, remember what you're doing is say, I don't want to buy the euros today, but I want to lock in today's price for 3 months from now. Forward, buying the currency in the future. And what determines that price is where the spot market is plus the cost of money. And so what's the cost of money? It's the interest rate differential between those two countries. And so when you have the forward, you ask if you like the bank will quote you a forward, and what we're doing is we're trying to decouple the spot price from the interest rate component. And then with that interest rate component, we're annualizing it, and we're putting it together with the other countries on a GDP weighted basis. So what we're going to have basically is in effect, it's a 1 month implied interest rate of holding the world's currencies. Yeah, but it is true like about the markets. I mean, just feel like, just when you think about it, is you could think that like, and you probably see it as a journalist, some news comes out, the markets react. But what the markets ultimately, what the people who are like the true believers of the markets think, is that the markets like digest all the known information and certain expectations about the future, like a big discounting machine. And so the markets are always looking to the future. So for example, next week, the US and the Eurozone are going to report Q3 GDP numbers. They're likely to be strong because we had this huge drop in Q2, a big snapback in Q3. But here we are talking in the beginning, 1 month into Q4. Q3 data might have a headline impact, but we're not really interested in it so much. We really want to know what's going to happen here, what's going to happen tomorrow, what's going to happen next week. And you know, the couple of days before the US election, we get the jobs data. And the interesting thing about how the market's looking forward is that the market is already beginning to talk about a negative number. The US might have actually lost jobs this month, partly because of some seasonal adjustments that don't take place because of the schools and how that's working. And secondly, we have several 100,000 census workers that no longer need their jobs, or I should say, the government no longer needs them. And so some economists are already talking about a negative non-farms payroll print a couple days before the election. And so what's the market doing? The dollar is getting hit pretty hard today. Not just against like one or two currencies, but against even emerging market currencies. So I think that, as we were talking about last week, if the PBOC wanted to steady the currency by changing the reserve requirements for forwards, as the dollar gets weaker, so it's not just the RMB getting stronger. That might have been the way it was a couple of weeks ago, when the Golden Week holidays, ended. But now it's a question not so much of a strong RMB as a weak U.S. dollar. Because this year of all years, GDP is really like, it's very volatile. Usually small incremental changes, especially in the Western industrialized or the high income economies, where growing 2% is a big deal. And so I think you're right that this is a strange year. But I think that for me, regardless of how the election turns out in the U.S., for me the underlying concern is that we have an old instrument, the dollar index, that no longer really, I don't think it ever really reflected what was going on in the world, but especially doesn't now. And I think that the rise of economic nationalism, regardless of the election in the U.S., I think that's on the rise. And I think we need to have more tools then to think about the global economy, to think things not just trade-weighted, but globally so.